Good evening and welcome to another rousing rendition of Bond Squad After Hours. That's right, folks, it's Back to the Future Day. This was the day that Marty McFly was supposed to arrive in the future from 1985. Sorry, we have no hoverboards. We have no Mr. Fusion machines to power our cars, and thanks to my New York Mets, it does not appear that the Cubs will win the World Series this year. Still 4 potential games to go, so they have a shot, but it doesn't look that way. And this provides a good lesson, even though it's only a fictitious show, that what we think might happen in the future, how we predict the future, how we forecast the future, doesn't always come true. In fact, more times than not, it doesn't. And we can look at forecast estimates, even movies and documentaries about what the future might be like made 30, 40, 50, 60, 100 years ago. And in rare except for rare circumstances, it hasn't panned out. So let's begin our discussion with our disclaimer. Investment advice is offered through Private Advisor Group, a registered investment advisor, and by a registered investment advisor. WSM LLC and PAG are separate entities, as is Bond Squad. The opinions voiced in this material are for general information only and are not intended to be to provide specific advice or recommendations for any individual. All performance referenced is historical and there's no guarantee of future results. And I cannot stress enough the importance of suitability. There is no one investment recommendation that's good for all investors. Not one. So, all right, let's begin tonight's discussion with our first bullet point, the strong demand for short-term treasuries. Now, those of you who do watch the interest rate markets might have noticed that from time to time over the past several weeks, U.S. T-bills have traded at negative yields. In fact, as I said here, and the bond market's still open until 5 o'clock Eastern time, technically you can trade at any time, but that's the official times, the January 2116 bill, aka the bill, is yielding 0 on the offer side. Yep, 0. You get 0 return for loaning the government money for 3 months. And that's one which we shall ignore because whoever's calling should be listening to the show or watching it. And so what we're seeing is this demand for treasuries. Now, it can't be just nervous investors looking to buy long-term short-term treasuries. There has to be something else to get them to buy at 0. There's no, last time we saw them at this level, we had panic in the global fixed income markets during the financial crisis, right? So what's causing this? And part of it is regulatory. A good part of it is regulatory. There are regulations set to go into effect next year, which pushes money market managers to hold mainly U.S. Treasuries in there. And some of them, a good many of them, Fidelity being one of them, is looking to get ahead of that. So what they're doing, these managers are rotating out of other assets into short-term U.S. Treasuries, T-bills. And they will buy them because of regulatory concerns at 0. And this is what I try to get across in my newsletters, in my conference calls, in my branch visits, and on this program, is that mean reversion is, how can I put this, a poorly conceived strategy, and it acts as a security blanket. People latch onto it, when their model, the strategy isn't working. Oh, wait a while, the mean will revert. Yeah, maybe revert over a decade or 2 or 3, or maybe a half a century. That's not a whole lot of, doesn't do anybody a whole lot of good if you're waiting that long. So we have to acknowledge changes. And one of the changes in the interest rate market is the structural demand for regulatory reasons for short-term treasuries. There's no yield to be had there. There's no alternative, except maybe government agency debt. Freddie, Fannie, Home Loan Bank, Farm Credit Bank, Federal Judicial Office building of this. Some of those bonds are still around, and so on and so on. So there's this demand that didn't exist, at least not to the extent it does now, in the past. And this has to be recognized. We see this on the long end of the curve, too, by the way. We see that the 10-year Treasury is, as I'm sitting here, is yielding 2.02, 2.025 right now, to be exact. So I guess we could round it to 203 for those who want to be picky. All right, the problem here is that it's always assumed that the 10-year will trade at X amount of basis points over inflation, maybe 2 points, 2.5 points. Right now, if you look at headline inflation, it's trading, well, headline CPI, it's trading where? About 1.5 again, not, 1 at 170. So it's tight. But who's to say that it has to be as wide as it was before? What if it is that the structural demand from foreign central banks, demographic forces, and so on, argue for a tighter relationship between the 10-year Treasury and inflation? That could very well be. It's not written in stone that it has to be tighter than that. There's that tends to augur for a lower inflation rate, right? Well, maybe the demand for treasuries is such that the long-term treasuries, at least not right now, are pricing efficiently to inflation. Maybe those who say they're all overpriced have a point, but maybe it's a supply and demand situation. The structural demand is such that investors, at least on the current conditions, are willing to take less inflation protection when buying treasuries. And that could very well be. Now, I don't buy the fact that once oil prices normalize, whatever that means, we're going to see higher inflation across the board. I don't even think that when we see the year-over-year oil price change go to zero, because eventually, we'll hit a point where we're $45 or $50 now, or we were that last year. That's gonna take the disinflationary effects off the headline number. That doesn't mean that the core number is going to move at all. What we should probably see is the headline number, which is well below core. In CPI, it's about 170 or so. That's going to start moving up. They're going to converge, right? But where's it going to converge? I don't know. Maybe converges at 1.5, 160. Well, why not all the way back to headline inflation is 190? Well, because higher fuel prices, let's say, if that happens, if we do see a move up in oil prices, is disinflationary elsewhere. But CPI is so skewed by rents. The rents are over 20% of that component, and with rental costs way up, because that's for both consumer taste and economic reasons, that's the dwelling mode of choice at this point for a large number of Americans. It skews the number. So we should look at PCE. Well, PCE is a lot less. It's like 1.2, 1.3. It's bouncing back and forth on headline, and it's just above zero on core. I mean, vice versa, rather. It's 1.2, 1.3 on core, just above zero on headline. All right, that's a better picture. So if you look at core PCE sitting in the low to, maybe if we're lucky, the next count mid ones, who's worried about inflation in that segment? Maybe 50 basis points over the rate of inflation, or 70 basis points over the rate of inflation is enough. It works like that with credit spreads, doesn't it? We see when there's a reach for yield that investors are willing to take less risk premium to generate return, and we saw that in the credit markets last year, where credit spreads, the difference between corporate bond yields and treasury yields narrowed to a narrow point. They tightened to the narrowest point since the housing bubble. All right, so that happens on risk too. So it can happen on inflation risk too. We can see credit spreads compress. Now they might stay there. They might stay there until something changes. All right, and we're not seeing that change in inflation yet. We are seeing the change, or have seen the change, in the credit markets. And what was interesting is that at this point in the recovery, if you believe we're still in that middle inning, still expansionary portion of the economic cycle, which I don't. I believe we're in the eighth inning, but the eighth inning is going to be long. It's not going to be like ninth inning next year. We were all taught that at this point we should see credit spreads narrow, rates come up, and credit product perform better, not move up in rates. But what happened was, with the Fed's very aggressive policy, we saw that spread narrowing happen already, way before this, happened before it would have otherwise. But that's what the Fed policy does. It pulls forward events. It doesn't create or destroy anything. It just pulls things forward. So what happened this past year, we saw the economy start to level off, slow down from its pace, but not go into recession, or not even near recession at this point. And we saw something happen in all the credit markets. All the credit markets, depending on the quality, hit their narrowest point since the recession, or since the housing bubble, sometime between last summer, and that was when high yield credits got the narrowest, to this past spring when investment grade credits got the narrowest, when people started to rotate up a bit. And so remember, when these spreads widen out, depending what Treasuries do, it creates tighter credit conditions for corporations, or more expensive borrowing costs. And we can see that here. I can't show you for compliance reasons, which is always a wonderful thing here at Bond Squad. But when we look at the triple B rated corporates, well, triple B rated corporates were bouncing around an average yield, not spread, an average yield of all maturities right around 3.5 for most of the second half of most of the summer of last year, 14. Then we see it start to pop up a bit at the end of the year. Remember, we had China starting to boil over, Japan was slowing down, we had the European crisis ready to heat up again. And then when the ECB said, we're going to ease like crazy, QE until forever, they narrowed to get to the narrowest points back in April of this year. At that point, we saw the average yield of triple B rated U.S. corporates of all maturities fall to about 3.39. Now, this wasn't much of a spread tightening because we also saw Treasury start to come down there too. We had the 10-year U.S. Treasury below 2 at that point, so that's not that big a deal. Then we saw both Treasury yields and corporate bond yields start to rise. And if you look back to about June and July, you saw the 10-year Treasury hitting 230, 240. But what happened with triple B rated corporates is that the yield went from 339 on average in April. By the time they peaked in the panic of September, they were at 416. Meanwhile, the U.S. 10-year Treasury is back in the low 2s at that point. So there was a good 80 basis point, 85 basis point increase in the borrowing cost for triple B rated investment grade corporates. Now they've since come back down to about 405. So they're about 10 basis points off their wides. But that's not terribly high, even though they did get about almost a full point of rate increase. Remember, they got a tightening there, 80 basis points, 0.8. They almost got a full, triple B rated corporations got almost a full point of interest rate tightening, at least effective interest rate tightening, by the credit markets demanding higher yield to lend to these companies. Now we can flip over to double B rated, just below investment grade, and we see that the yields for double B rated corporates, they hit the lowest and the narrowest point of the U.S. Treasuries with the end of last June at about 451 on average. Well, they spiked up to 6.32 back on October 5th. Now they've since recovered. The average yield is about 5.75 now. That's still a 125 basis point rate increase for these double B rated companies. That's a 1.25 tightening. We were fretting about a 1/4 point tightening by the Fed. Well, the credit markets just gave double B credits even after some recovery in the last couple of weeks. 125 basis point, 1.25 tightening. Now that doesn't matter. Such a tightening wouldn't matter so much for high investment grades, and they didn't really get anything at all. The yields haven't moved a whole lot on those, except for Treasuries on AA and most single A. But a high yield rated company, they're more sensitive to this because they often rely on financing, constant financing, just for their daily survival, for liquidity. And when those markets get constrained and the cost goes up, you can have problems there. But double B is just below investment grade, and most of those companies are kind of weathering this okay. But when we get to the triple C area of the market, the area of the market that many investors, whether they know it or not, have gained exposure over the past 5 years, that gets ugly. And this includes loans too, not just bonds. All right, if we go back over the past year, and we'll go back to last June, and put that right date in there, we see that triple C rated corporates of all maturities had an average yield of about 8.73% back on June 20th, my birthday of 2014. Right after that, I said, this is it, stop taking risk, move up in quality. Most people listened to the global investment committees and didn't do it. Even my paid subscribers, that I can't control, but I gave you the info. Well, what happened since then is that the average yield went from 8.73 up to 14.66%, and that happened back on October 5th. Now they have recovered, but only down to about 1405, let's call it. Wow, think of that. You went from 8.75 to just over 14%. That's over 500 basis point tightening. A 5-point tightening is what triple C companies got on average. 5 full points. These are the cracks I'm talking about in the credit markets. And if this isn't rectified soon, and I don't think it's going to, because I think this is closer to reality where things should be priced, we're probably going to see credit defaults pick up at the bottom of the junk market. And here's what's likely to happen given human nature and my experience with the markets. You'll see cracks there. So people will sell out of their high yield investments. Well, that means they call their advisor up and say, get me out of high yield. So the investment advisor gets them out of high yield. And that means triple C gets sold, single B gets sold, and double B gets sold, especially if the portfolios are managed by some sort of manager, especially a manager that doesn't have a custom and bespoke portfolio for an individual client. So they just sell what they can, not necessarily what they want. This creates contagion to the junk markets. Now, if you own the actual bond and you own a better triple B name, let's say you have American Tower, which is kind of split rated, and they get hammered just because they're guilty by association with the rest of the junk. If you own the actual bond, well, American Tower is not that bad of a company, right? You can hold on and keep clipping your coupons, and on maturity date, if the company remains solvent and the creek don't rise, you're going to get par. But if you don't own the actual bond, what happens is that you get sold out as well as the guy who wants to sell, and you get a realized loss, and you're holding a good bond. Or, you want to own the actual bonds here. There are cracks forming in the credit market, and the bond market is telling us something. We don't have a 2.02% 10-year note for no reason. Some of it's structural demographics, some of it's a currency arbitrage and carry trade going on with foreign currencies and interest rates. But a lot of it here is that the bond market doesn't buy that we're out of trouble. Or at least, probably in my opinion, I don't think the bond market believes that we're ready to resume the pace of growth that was factored in to previous asset prices. We're in a situation where the U.S. economy is slowing. Atlanta Fed forecast that we're going to go 1.5. The blue chip forecast is around 2. Right? We've seen weak regional Fed reports. We've seen weak job components of the regional Fed reports. ISM reports have been disappointing. We've had employment data for the past 3 months, 4 months. No, 3 months. Sorry, June was good. 3 months that have deteriorated. And there's nothing out there that shows they're getting any better. What we're seeing too is a drop in fixed investment from businesses in China, and all that lack of demand for equipment is washing up on our shores. Deflation is washing up on our shores. We're all connected. And we might not go to deflation. We could stay in lowflation though. And we could see, and this does not surprise me. I haven't crunched the numbers yet because not all the numbers are in to crunch. But we could see 150,000 jobs this month. For October when it was reported the first Friday in November. All right, what does the Fed do then? We can see wage growth in the 2 to 2 range. Okay, and this is what I mean. I don't think that the equity markets have corrected in so much as they've reset, and they might have reset a little too high here. I think what we have going on is a little Tina. There is no alternative. You can't buy bonds if you're a total return player, right? That's what we all are now. We all buy things based on price. We don't care, about income and capital preservation anymore. We try to hedge it out with derivatives and alternatives, and we try to build a Goldberg machine that something complex to do a simple job like a bond ladder or a barbell could do. So we have to make things more complicated, of course, right? So I think we're resetting, and we're resetting close to reality. So I think the 14% junk bonds, triple C junk bonds, might be normal, and you might see single Bs, hit the 8s and 9s. You might see double Bs go back up to the 6s at some point. I don't think that we're going to see the 10-year yield break much above 215, 220 in the near future. Up till last month, there were still pundits out there, mostly on the equity side, or from large firms whose global strategy was calling for higher rates. Why? Because it always happens. They did their homework. They look at the backward-looking charts, and they know what's going to happen, because it always happens. Pay no attention to the fact that 18 and those age 18 and under, in the U.S. population make up only 24% of the U.S. population. That's like cut in half over the past few decades. Pay no attention to that. Pay no attention to the fact that Americans age 65 or over have spiked in the last 15 years. Pay no attention to the changes in the U.S. economy. But no, we go merrily along thinking that mean reversion is going to work. Well, you know what? I ran some numbers today for the people in my office, and the U.S. economy grew 3.2% in the 1970s on average, and 3.1% in the 1980s, and 3.2% again in the 1990s. And you tell me if policies in any of those decades were similar to the others around them. But we grew at 3.2%. Were interest rates the same? No. The Fed funds rate average in the sevens. In the 70s, averaged at 9.98. In the 80s, and averaged at 5.17 in the 90s. But we get the similar rates of growth. But policies had to be different to get those rates of growth. And in the 90s, it was ever lower interest rates to do that, because as each consumer, that was an interesting noise outside. It's what happens when you have an office on Main Street in a small town, I guess. But what we had was each consumer structurally was not able to consume like he or she did in the past, or was not willing to. Remember, we had the breakup of unionized jobs. We didn't have regular cost of living, wage increases. We had competition from overseas and automation. So what the Fed had to do, absent fiscal policy, was lower rates to try to get each consumer to consume more via leverage, or if it was by their paycheck, by lowering their monthly expenses, by lowering their mortgage costs, or both. Lower rates so much that they could refinance at a lower rate and take equity out and still not increase, or sometimes even cut their monthly payment. Well, that's over. You can't do it. We're at ZERP. Where mortgage rates are in the 3s. Where are you going? So how can you say mean reversion is possible even, the way it is now? Because what tool is going to be used to get us back to the old mean? Especially when we're all integrated, all economies are integrated, and we're almost just as influenced by foreign policy, by foreign economic policy, than by economic policy set by our own policymakers. So that's really not in the cards, is it? So where are we? We're at a 2% economy with 2% wage growth, with 1.5% core inflation. And for the life of me, I don't see any real impetus for getting us out of it. You can't just say, "Oh, it always happens." We just sit back. If mean reversion is so darn good, why do we even bother planning? Why do we have a financial plan? Why have a portfolio? We should all just buy the riskiest thing we can and say, just because it's going to revert. Put it all in stocks. Put it all in the long bond. Put it all in junk credit. It's going to revert. Everything's going to be okay. It's going to revert. Well, that's kind of stupid now when you think about it, isn't it? But that's exactly what some some pundits are saying, some strategists are saying, even some advisors are saying, things don't revert just because they do. Any reversion in conditions was because policymakers, business leaders, or consumers did something different to adapt to changing conditions to make us revert to traditional rates of growth. But for the last 20 years, or for 20 years ending with the financial crisis, it was the Fed, and almost completely the Fed, that generated growth. Now the Fed is pretty much out of bullets. Now what? You have disinflation flowing in from overseas. Well, technology and competition is inherently disinflationary, right? Why have we outlawed monopolies in this country? Well, because it's bad for the consumer. There's no price competitiveness. They can corner markets and set whatever price they want, and it's not healthy for the economy. It's not fair for the consumer. So they want competition. Well, what does competition do? Well, the competition for consumer dollars lowers prices, right? So we have global competition for manufactured products and for services. And that competition is disinflationary. So again, there's not a mean reversion. We never had this before. So all right, before we end, let's talk a little bit about duration and how to cushion portfolios. I've actually been made, I volunteered, because nobody else wanted to do it, the head of a study group at Private Advisor Group's conference in Philadelphia next week. And I was going to talk about this before I got an email from one of the other group members who wanted to know how to position against rising rates without using floaters and using floaters and I think alternatives, he said. But I can't remember. It was definitely floaters. Oh, short duration. I'm sorry. It was using short duration, persisting having a short duration investments or floaters. It's really not that difficult, but we have to understand what duration is. Duration, it can be several things. It can be weighted average life of the cash flow. It can measure the volatility of a price versus moving interest rates. We have effective duration, which prices in or prices out the call probability. So when rates are low, the call is probable. Effective duration will start to move towards the call date. I'm simplifying here. When rates are higher, the call falls out of the money. The effective duration is going to start gravitating to what it would be if it was a bullet, a non-callable bond. But not too many people understand duration. When they buy short duration portfolios, they say, "Oh, short duration, I must not have much risk." You might, because some of that duration might be calculated using effective duration. So as long as rates stay low and you have high coupon callable bonds, that effective duration will stay low. In this environment, you can have not so high coupon callable bonds, and rates are so low, you'll have a low effective duration calculation. But if rates rise up, that effective duration starts to blow out. And when the call falls out of the money, it blows out all the way, almost all the way to matching what a bullet, a non-callable bond would be. Not quite, because there's always the chance that the option can be exercised, the call option can be exercised by the issuer sometime down the road. Trying to get out here. But that's a way to mask really. I hate to use mask. I don't think probably is done on purpose actually, to make a portfolio seem like it has a shorter duration than what it does. Now, that's not necessarily bad if you understand that and you understand how you're getting your shorter duration. You can plan around it. A simple way to plan is a barbell or a ladder. There's really not much to do. I built a portfolio today for somebody with an average credit rating of A, an average yield to worst of just under 3, an average yield to maturity just over 3, an average duration of about 5 3/4 years. It was kind of barbelled. It wasn't that difficult to do. If rates rise, my short end can be rolled into higher rates. If rates don't rise, I'm protected somewhat by my long end of the portfolio. Give me a high relative interest rate. On the long end, I tend to go towards higher coupons, because higher coupons not only generate more cash flow for investors who are living on an income, but if they're reinvesting, that's more again on a timely basis to reinvest into higher rates as rates rise. So if I have a 5% coupon 10-year bond, and I have a 3% coupon 10-year bond. If rates rise, the 5% coupon bond is less volatile because the holder of that bond can take a higher cash flow, take it and reinvest it into higher rates on a periodic basis. The 3% bond owner has a smaller cash flow to reinvest. This is kind of a lost art out there. We do a bunch of pie slices out there. We have so much fixed income, so much equity. We sit back like this and go, what a good advisor am I? There's more to it, especially on the fixed income side. And I will almost guarantee that almost all of your books within the next decade are going to become very concerned with income and capital preservation. The demographics of your books out there are going to age and age and age. And you're not going to be able to do it with alts. You're not going to be able to do it with equities. You're going to need actual bonds, whether you know it or not. And if you try to do it some other way, and we have an unexpected event out there, or the markets don't revert to the mean, or the economy doesn't revert to the mean, or interest rates don't revert to the mean, you might have a rude awakening. All right? So I'm running a study group next week at a private advisor group's conference, so I'm at least heading it, I'm not really running it. I like to do that for my subscribers, for anybody who's interested. We can get through this together without it being thinly disguised marketing. And that's what I see up in the financial media when so-and-so from whatever firm goes up there and to give opinions on the market and positioning. It's a sales pitch. When the people come through your branch office, it's a sales pitch. I'm not selling anything. Yeah, I do manage portfolios, but I don't have anything pre-made. Anything I do, I build custom. I'm not selling anything. I'm selling my service. You decide if you need it or not. And with that, have a great day. And we want to end this with another song. As soon as I put this back on. And this is for my team of teams. Have a good night, folks, and let's hope for a sweet. Good night.